Welcome to ETF.com video series. I'm Cynthia Murphy, Managing Editor at ETF.com, and I'm here today with Kevin Carter, Founder and Chief Investment Officer of EMQQ. Thanks for joining me, Kevin.
Thanks for having me.
So this year everyone is excited again about international markets, international equities specifically, emerging markets in particular. You're an emerging market guy. Tell us what's the big picture, why emerging markets look so good this year.
Well, I think emerging markets have been out of favor. Last year was a particularly tough year for emerging markets. The broad indexes were down a lot. The emerging markets internet sector that EMQQ tracks was down about 30% from its high early in the year to the end of the year. And I think that valuations for emerging markets look quite compelling. Valuations for the emerging markets internet sector seem quite compelling because we had a big sell-off that seems to have been tied to fears of the trade war and tariffs. And I think if and when that is resolved, I think it's likely you'll get some sort of a relief rally. So I think emerging markets, you want to buy things when they've performed poorly is usually a good way to be looking at entry points, and poorly is how they've recently performed.
So everyone has, or most people have, some emerging market allocation in their portfolio. What about the trade wars? They really have to keep in mind, they really have to understand as far as how it impacts that allocation. Is it all about China, or are there other implications for the emerging market space that investors really should understand?
Well, China is the biggest part of emerging markets, both in terms of population, in terms of stock market cap. So it's, it is going to be the largest allocation in almost any emerging markets fund. But one of the things that I think people don't perhaps totally understand is, I think there's a real problem with the emerging market indexes. And if you look at the composition of what are the top holdings in EEM or IEMG or VWO, the large, broad emerging market funds, there's about 30% that is in Chinese banks, oil companies. The problem with using a broad emerging markets ETF is the government-controlled parts of the economy and the types of things that are going to be affected in a trade war. Right, manufactured goods and so forth. So I think investors should be careful with broad market exposure, and ultimately the real story of emerging markets is the consumer. That's where the growth is, and EMQQ is designed to capture the next phase of that growth online and through a smartphone.
So the whole consumer story, which is what everybody talks about in emerging market space as being, where you talk about the growth is, does that work in every market cycle? Is that going to continue to be the strong story in emerging markets, or is there other ways to tap into emerging markets?
Well, the fundamental growth of the emerging market consumer is strong, and that's going to continue to be the case broadly. Certainly, certain economies will do better or worse in certain times, but the secular trend is billions of people moving on up, right? The thing that's emerging are the people. And they're 85% of the world's population. As they increase their incomes, they want more and better stuff. Food, clothing, appliances, automobiles, and Harvard educations for the kids. So that's been the story since I got involved in emerging markets 15 years ago. McKinsey calls it the greatest growth story in the history of capitalism, and it's alive. For certain, but the way people consume is changing. So the emerging market consumer ETF has not performed great over the last several years, and I think a lot of it is that just as in our lives, consumption is changing. Right? When you turn on CNBC during earnings season, there's the retail death watch,
right,
which traditional consumption companies are struggling, and the FANG stocks are fundamentally doing well business-wise. And so the same thing is happening in emerging markets, but the difference is, they don't have the existing consumption infrastructure. They don't have the Target stores. They don't have the SUVs to drive to the Target stores. And so they're leapfrogging and doing basically everything on their smartphone.
Yeah, but I would also think the consumption story is relatively sensitive to the market environment. When the markets are doing poorly, the economies are doing poorly, the consumer isn't going to be spending. So is it a more volatile ride in that sense, or?
Well, the emerging markets are a volatile asset class,
right,
and certainly the emerging markets internet companies are even more so volatile than that. But the fundamentals of the economies are by and large quite good. I mean, India is growing at about 8%. China, even though its growth rate has slowed, it's still growing at 6%.
Right.
And so 2.5, 3 times what we're growing. So the growth rate has slowed from 6.5 to 6 recently, but that's not news. That's 15 years ago when China was growing at 12%. The people that sort of indoctrinated me into how to think about China, that was our first day. It's going to go down to 10, from 10 to 9 to 8
Right.
to 7 to 6 to
Right.
5 to 3 eventually. And the most recent decline from 6.5 to 6 is just part of that process.
Okay. So here's your opportunity, EMQQ. Why is that a better mousetrap to emerging market as opposed to just a broad total market ETF, other than the Petrobras, the state-owned enterprises that are the problem? Why is that one is the best?
Well, this sector represents fundamentally the single greatest growth story in the world. Well, not just today, but perhaps ever. Right? The revenue growth for the sector, EMQQ, is about 35%. Top line growth. That's hard for a single company to do. If you're a local flower shop and you grew at 35%, you'd be thrilled. But these are, this is $1 trillion of market cap, and large companies, and they're growing at an incredible rate. And the valuations presently, after the sell-off, are I think quite favorable. The PE's in the low 20s, the growth rates mid 30s, so a PEG ratio of below 1 and perhaps as low as 0.6, 0.65. So I don't make short-term market predictions, but the fundamental story is super intact as all these billions of consumers get their first computer. Just remember, we've had computers before the smartphone. Most people will never have a computer the way we think of a computer. We had the internet before. Most of the world never had the internet. So, as we're talking, 1,000 people in India will get their first computer, and it will have internet access, and they'll be home tonight in their beds looking at it. So that's a secular story. It's a long-term story. The valuations, I think, are quite compelling, largely as a result of the big sell-off in 2018.
Awesome. Well, with that, I want to thank you for joining us today. Thank you all for joining our video series.